Hi, everyone. I'm Jennifer Tim, Real Estate Wealth Advisor, and welcome to your midweek market brief for the Portland metro area. This is where we cut through the noise and focus on what actually matters: the data, the trends, and the opportunity in today's real estate market. Because here's what we do know: the headlines may change weekly, and boy, there are a lot of them at the moment. But the data leaves clues, and those who follow it are the ones who move ahead. Today, we're going to take a look at what's happening nationally, locally, and most importantly, what it means for you and your real estate plan, because your legacy begins with a real estate plan. So let's start with what's happening at the national level. Mortgage rates spike, but housing demand has definitely not broken. So the mortgage rates jump back up. Mortgage News Daily put the average 30-year fixed at 6.49%, up 13 basis points in a week, while HousingWise locked loan data shows 6.28% for 30-year conforming loans. Why rates are moving higher? Oil. Oil climbed above $100 per barrel, and Treasury yields rose as markets priced in more inflation risk tied to the conflict in Iran. The Fed is on hold. The Federal Reserve kept the policy rate, this is the Fed rate, not mortgage rates, at 3.5% to 3.75% in March, and projected higher near-term inflation, which reinforces a higher for longer rate backdrop. So spring buyers are feeling the crunch. Those higher rates raise monthly payments. And this was right at the time when the market was improving. But of course, affordability is always the biggest hurdle. And we'll have to wait and see. So the locked-in effect is still alive. More than half of outstanding mortgages are below 4%. So many current owners still have little incentive to sell into today's 6% financing environment. Inventory is improving, but pretty slowly. Active inventory is up 5.6% year over year, giving buyers more options, but the pace of recovery definitely has slowed. Prices are softening at the list stage. The median listing price is down 2.3% year over year, marking 21 straight weeks of flat or negative annual list price growth, and price per square foot fell 2.6%, the lowest in Realtor.com data back to 2017. Homes are taking longer to sell. Listings are spending about 4 days longer on the market than a year ago, which means that buyers still have more time and more negotiating room than they did during the frenzy years. Demand is weaker, but it definitely has not gone away. Mortgage applications fell 10.9% week over week, yet the purchase index still rose 1%, and pending home sales increased 1.8% in February. Builder signals are mixed. Builder sentiment ticked up to 38, but new home sales plunged to 587,000 in January, basically showing that affordability pressure is still slowing the market. There is an important inflection point. HousingWire noted that the demand is still growing with rates above 6.25%, but historically, the market gets more fragile as rates move closer to 6.64% and above. And right now, we're sitting at 6.48, 6.49. So having a look at Mortgage News Daily, they actually ended up just after noon today at 6.48% for a 30-year fixed, 15 years sitting at 6.09%, and both FHA and VA are sitting closer to that 6% or at 6%. And their headline today: rates ease despite conflicting Iran war headlines. So we've definitely seen lots of different stories that seem to contradict themselves. And there's a ceasefire, there's no ceasefire, there's negotiations, there's no negotiations. And as far as the rate market is concerned, the most important development has been the general appearance of a shift towards diplomacy and resolution on the US side. So this has been enough for oil prices to preserve a majority of the drop seen at the start of the week. We shall wait and see. So this is where I always like to share what I call the smart money insight, because it's not just about what's happening. It's about how to think about all of this. So this is not a broken market. It's a very sensitive market. Buyers are still active, but every jump in rates changes the behavior fast. The spring market is being shaped less by headlines alone and more by the math of monthly payments. So it's all about that affordability. So follow the spread between rates, inventory, and list prices. Right now, inventory is up, list prices are softening, and pending sales are still finding traction. That tells us that the market is bending, but it's definitely not collapsing. Now, waiting for the perfect conditions is definitely still a risky venture. If rates retreat again, sidelined demand can re-enter the market pretty quickly. If rates stay elevated, well-priced homes and strong markets will still attract serious buyers because supply remains constrained. The bottom line, smart money is not trying to predict every geopolitical headline. Smart money is watching whether affordability worsens, inventory expands, and demand holds. Right now, the market is volatile, but it is still functioning, which is a really good thing. But the most important thing is how this all relates to you locally, because as we know, it's the local impact that's more important for you and your real estate plan. So starting out with Portland, our market action index is sitting at 43, and that is a slight increase. And our median list price is up to 649,000, price per square foot 322, inventories up to 1,075 homes. It's really just fluctuating just by a couple every single week. And our median days on market is down to 42. So the smart money insight, 33% of listed properties are showing a price reduction. And that shows that buyers remain price sensitive. So they're really looking to make sure that you're pricing correctly. Portland is entering a re-acceleration phase beneath the surface. Even with higher inventory and price reductions, homes are selling faster, a clear sign that demand is quickly strengthening. Smart sellers price ahead of the market, and smart buyers recognize this window before pricing pressure builds. Lake Oswego, our market action index is up to 36. We're a slight seller's advantage. Our median list price is 1.7 million, which is up. Price per square foot is up to $543. Inventory is 140 homes. Median days on market has gone down to 63. Our smart money insight is 25% of homes are seeing price reductions, and that's continued sensitivity at the higher price points. Lake Oswego is a strategic opportunity market. Luxury and move-up buyers are more selective, but supply remains limited enough to support the pricing that's there. This is where precision matters. Sellers must price correctly, and buyers can negotiate on overreaching listings while long-term value remains strong. And finally, Beaverton, our strong sellers market at a market action index of 47. Median list price is 649,960. Price per square foot down to 294. Inventory of 171 homes is down, and median days on market at 42 days is down. So our smart money insight, 37% of listed homes have seen price reductions, but demand continues to absorb the listings. Beaverton is leading the Portland metro in momentum and strength. This is a classic affordability-driven demand surge. Buyers are competing in the more attainable price ranges, and smart buyers act decisively here, while sellers who price correctly are positioned to benefit from continued upward pressure. So keep watching your feed for market data for some of the other areas that we cover, and thought it was prudent at the moment because even globally, with everything happening from inflation pressures to geopolitical events, what we're seeing is that real estate is still being driven by fundamentals like supply, demand, and purchasing power, not just the headlines. So how does it all fit together? Number one, real estate is not directly impacted, but it is financially impacted. Wars really impact real estate directly. The real impact comes through oil prices, inflation, interest rates, and consumer confidence. So we're going to look at some of those. Insight: real estate doesn't react to war headlines. It reacts to money, debt, and confidence. So looking at oil, and this is the global trigger. Oil prices have surged 25% since the conflict began. I think we can all relate to that if you've been anywhere near a gas pump in the last 4 weeks. The Strait of Hormuz carries 20% of global oil supply. Higher oil equals higher transportation, construction, and living costs. So that real estate impact is definitely higher construction costs. Steel, cement, materials rising. Increased costs to build mean less supply, and then that long-term upward pressure on prices. Looking at inflation, interest rates, and housing activity, rising oil means we have rising inflation fears. Inflation pushes bond yields and mortgage rates higher. Central banks globally may, and we've seen that already, delay rate cuts or even consider hikes. Global pattern emerging. Buyer activity slows short-term, sellers hesitate, and that inventory tightens, and the markets become rate sensitive, not demand free. So we'll kind of dive into some of those other points in next week's session, but our smart money insight at that global level. Global real estate is entering volatility window, not a collapse. The fundamentals remain: housing shortages, population growth, long-term demand. And the biggest mistake globally right now is trying to time geopolitical events. As one economist noted, shocks like this are exactly why timing the market is so difficult. Honestly, conditions can shift in days and, honestly, hours at the moment, depending on what is happening. So here's where we were really seeing, when we move into our wealth building insight, real estate continues to be one of the most powerful tools for building long-term wealth. And in markets like this, smart money isn't sitting on the sidelines. It is really watching the data, identifying opportunities, and making strategic moves. Because the goal isn't to time the market perfectly. It's to be positioned correctly within it. So again, wealth is built through time in the market, definitely not timing the market. Good luck with that one. Even in shifting markets, equity continues to compound over time. And today's market rewards those with a clear plan, not perfect timing, because none of us can time exactly what's happening. So the families who win are the ones who stay in the game with a strategy. So just getting down to our the most important part of this is, smart money is not waiting. It's watching inventory rates and those demand patterns. The headlines are everywhere and they focus on uncertainty, but the the data shows us that demand is still active, and we're watching the data every single day. Windows of opportunity open when prices soften, but demand remains, and strategic buyers and sellers act before the next shift, not after. So again, uncertainty creates hesitation for some and opportunity for those that follow the data. We always hear about those success stories of somebody who took advantage of an opportunity, and it's because they don't get distracted by the headlines. So what does this all mean for you? So as we wrap up today, here's what I want you to take away. The market is always moving, but not always in the way that the headlines suggest. Remember, the headlines are there for a reason, but the data is the data. We're seeing shifts in inventory, adjustments in pricing, and continued demand, but it's just behaving a little differently. And this is exactly why having a strategy is so important. Because whether you're thinking about selling, buying, investing, or planning in the future, planning for the future, it's not about waiting for the perfect moment that just doesn't exist. It's about making informed decisions that support your long-term wealth and your family's future. So if you're curious about what this means for your situation, or you'd like help creating your own real estate plan, I'm always here as a resource for you. Thank you so much for joining me today. And remember, your legacy begins with a real estate plan.